Hello and welcome. Today we're going to discuss mortgage insurance and the differences between traditional lenders and term life insurance. I'm Jacqueline Van Horn, and I'm a financial associate here at Experior. With me today are Jane Hanforth and Annie Coulierier. And Annie is going to start.
Thank you, Jacqueline. So first of all, what is term insurance? Well, term insurance is personal insurance that you would get through an insurance broker. It's a temporary policy. That's why it's called term. It has a specific term. So you can choose 10, 20, 30, years. The cost is based on your age, your gender, and your health. So the healthier you are, the more economical it will be. And of course, the younger you are as well. And you get to choose the amount of coverage as well as the term, like how long the coverage will last for.
And what is mortgage insurance? Mortgage insurance you get through your bank or your lending institution. The cost is based on the percent of the mortgage and your age.
So what are the advantages of term insurance? One of the main advantages is that the underwriting is done at the time of application. So if you qualify for the insurance, you know right then and there that you are covered. The only reasons you wouldn't be covered is if they can prove that you lied on your application, or if you commit suicide in the first 2 years of owning the policy. And another main advantage is the money can be used to pay whatever your beneficiary chooses to pay with it. So you name your beneficiary, and then they can choose to either pay off the mortgage in full or partially pay it off and use the rest of the money to invest it and then put the mortgage in their name and continue with monthly payments. And also, once your mortgage is paid off or before that, at any point in time, you can convert that term policy, which is a temporary coverage, into a permanent coverage. Another advantage is, as I mentioned before, you choose the amount of coverage and it's fully portable. So what that means is, regardless of if you are going to renew your mortgage, change financial institutions, it doesn't matter because this policy is yours. It's not linked to any bank or financial institution. And the insurance remains in effect until you cancel it. The only person that can cancel this policy is the policy owner. And the coverage stays the same throughout that term that you choose. Okay, it does not decrease as your mortgage decreases. But you can also choose a decreasing term policy if that's what you would prefer. And as I mentioned before, the rates are based on your age and your gender and your health. And it's typically, especially for someone who is healthy, cheaper than mortgage insurance.
And the advantages of mortgage insurance, so it can be good for people with health issues who wouldn't qualify for regular insurance. And it's also for those who would only qualify for guaranteed issue insurance, which is typically a maximum of $50,000 coverage.
Which wouldn't be sufficient to cover a mortgage. So what are the disadvantages of term insurance? Well, the only disadvantage really is if you wait for that policy to expire. So let's say you got a term 20, and at those 20 years, you can renew it. At that point, you are now 20 years older, so the coverage will be more expensive. But if you speak to your broker and plan ahead of time and do the changes earlier, it won't be as expensive. So it's all about planning ahead. But yes, it will get more expensive as you get older at the time of renewal.
And the disadvantages of mortgage insurance. So you'll need to reapply every time you renew your mortgage or you move it to a different institution, at which point you're going to be older, so it's going to cost you more. And the rates for mortgage insurance are based on all clients of the same age. And the amount of coverage is based on the balance owing on your mortgage. And another big disadvantage of mortgage insurance is that the underwriting is done at the time of claim. And to illustrate why this is such a disadvantage, I'm going to share with you a story. So in a small suburban neighborhood nestled between tall cedars and friendly neighbors, Jaspreet and Bhupinder had built a life together. They were the quintessential couple, sharing laughter and dreams and the joys of their charming house. One sunny afternoon many years ago, they decided to secure their family's future by purchasing their dream house through their trusted bank, which also offered them the option of mortgage insurance. With a firm handshake and smiles that held promises for the future, they signed the paperwork that would ensure their home remained a sanctuary, no matter what life had in store. As the years rolled by, Jaspreet and Bhupinder's family grew. Their home became the heart of cherished memories, where birthdays were celebrated, first steps taken, and bedtime stories whispered. Through the ups and downs, they paid their monthly premium with unwavering dedication, believing that they had secured their sanctuary against life's uncertainties. Then, one fateful day, tragedy struck. Jaspreet, a loving husband and devoted father, unexpectedly passed away. The world seemed to crumble around Bhupinder, her heartache echoing through the once joyful hallways of their home. In the midst of her emotional turmoil, she took solace in the thought that at least the mortgage was taken care of. But life had an unexpected twist in store. As Bhupinder submitted the insurance claim, her hopes were met with disbelief and despair. The underwriters, in a meticulous examination of the paperwork, discovered a seemingly innocuous detail. Jaspreet had indicated that he had never had his blood pressure checked by his doctor when, in reality, he had. It was a simple oversight. It was an honest mistake, but the underwriters deemed it enough to refuse the claim. Bhupinder was shattered. She couldn't understand how a single question could lead to the denial of their decade-long investment in mortgage insurance. They had faithfully paid their premiums, believing they were securing their family's future. Instead, they were left with nothing but an empty promise. With a heavy heart, Bhupinder had to make the most difficult decision of her life. She put their beloved house on the market, her place filled with memories of love, laughter, and family. As the for sale sign was erected in their front yard, Bhupinder couldn't help but feel betrayed by the system they had trusted. They had paid into this insurance for 10 long years, only to find out that they actually only qualified to make monthly payments, not to receive the actual insurance they so desperately needed. As she packed up their life and prepared to move to a different neighborhood and a different school district, Bhupinder couldn't shake the feeling that their dream of a secure future had crumbled under the weight of fine print. In the end, Bhupinder's story is a harsh reminder that sometimes, in the complex world of insurance, promises can be as fragile as the dreams they're meant to protect. This serves as a poignant lesson that when it comes to securing your family's future, it might be better to entrust a licensed broker who can provide you personalized guidance and ensure that you truly understand the coverage you're getting, rather than rely solely on a bank employee selling you your mortgage. After all, it's not just about monthly payments. It's about having genuine peace of mind. And with that, we'd like to thank you all for attending our free educational seminar on financial education. Stay tuned for our next free financial education on critical illness insurance, which will be held October 7th at 11 a.m. Pacific. Thank you, Jacqueline. Thank you, Annie. And thank you all who attended live.
Thank you,
The
Jane.
next one